Markets trade sideways after Wall Street saw selling pressure overnight. Nifty falls below the 50 DMA mark ahead of December expiry. Metals and autos fight for the bulls while realty and healthcare stocks drag.
Silver's furious rally turned around Monday with the precious metals' biggest one-day fall in more than 4 years. Gold and silver futures both slid after exchange operator CME Group increased margin requirements in response to recent volatility. Silver drops 15% from the highs in the biggest one-day decline since Feb 2021. Gold sold off 5% from highs last night.
The Secretary of Department of Financial Services tells CNBC-TV18 that the insurance regulator IRDAI is set to come out with draft regulations on insurance commission. The Insurance Amendment Bill, which was passed earlier this month, had an enabling provision for IRDAI to be able to regulate high insurance commission payouts. Hello, good afternoon. You tune into Halftime Report coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me are my colleagues Ekta Batra as well as Sonal Butra as well. Good afternoon, ladies. You know, we are just coming to the end of the year, but Nifty a bit volatile today. Very muted as such, not very sharp moves, but nonetheless, again, it's back to the day's lowest point and back in the red as well. So that is something that one should be keeping an eye out on. Nifty is also not doing much in today's trading session.
Yes, absolutely. And I think, hello, ladies, and good afternoon. But nonetheless, I think it's also because of the lower volumes that we're seeing in trade, because we are going into that, we are amidst that holiday season. So you're seeing these drastic moves come into asset classes such as gold and silver as well. So maybe there will be some kind of settlement which will come, which will possibly be more indicative of the rates come Jan 5th. So as of now, yes, the Nifty is just about lower by around 45 odd points. We have the mid-cap index, which is down around 0.4% at this point in time, and an advanced decline ratio, which could be wanting for more. So currently just about 1,000 stocks advancing to 1,700 stocks declining on the National Stock Exchange.
Yes, and also while we're talking about it being a Tuesday of December, which is the last Tuesday, so of course it's the monthly expiry. Tomorrow we'll have the Jan series already. So 2025 has been very interesting for our markets. We'll of course discuss that in greater detail. But for now, Nifty metals, they continue their run. So that index is up 0.8% as we speak. A lot of moving parts in the broader markets and mid caps have been under pressure for a while. At least the advanced decline ratio has been. So let's talk about individual names now. It's time for our movers and shakers segment where we track a whole host of buzzing stocks in trade. First up, let's talk about Indocount, Winnie. We haven't spoken about textile stocks in a while, but there's something happening in Indocount.
Yes, so actually it's a positive brokerage note that's coming from Avendus Spark. Now, they've written on Indocount Industries as well as Welspun Living. They've initiated coverage on Indocount by rating target price of 348 rupees per share, which indicated almost a 30% upside from yesterday's closing price. Now, they believe that the weak macro could stabilize in the near term. Policy clarity, once that emerges, that will be a better positive for the company as well. And they believe company is well positioned to be a beneficiary on obviously the trade deals that will take place. We have seen a lot of FTAs that have taken place as well. So that could be something that comes out and turns out to be positive for Indocount. Do not forget, Indocount is one of those home textile exporters that has 100% exposure to bed linen. They're operating at a very large B2B supplier as well, primarily in the US market. So once this trade deal actually comes in, they believe that there would be a lot of positives that come into place. Yes, falling US imports reflects that the demand right now is moderating a bit. Inventory is something that is a bit of a concern, but going forward, they're still positive on Indocount Industries, while they've initiated coverage on Welspun Living, but that is with a reduced rating and a target price of 135 rupees per share. So yes, the best case scenario for Indocount, they're expecting around a revenue growth of 13% over the next 3 years, PAT CAGR growth of around 20% as well, and EBITDA growth of 31%. So that is why Indocount Industries is what we'll be keeping an eye out on today. It's managing to hold on to good gains in the trading session as well.
Okay, all right. So that's on Indocount. But let's go across to Shilpa now. She's joining in on Eternal and QCom space and the quick commerce space. So Shilpa, tell us more.
Well, you know, it's another day and another pace of action that's happening in India's quick commerce space. Latest here, what we're picking up is that Blinkit's chief financial officer, Vipin Kapuria, has resigned in just over a year since he took the CFO office. Now, what we're given to understand is that he has now stepped down, and he had, remember, joined Blinkit as CFO in just October 2024. And he was actually the first full-time CFO they had had in over 2 years after Amit Sachdeva had quit in August 2022. Now, Kapuria had actually joined Blinkit from Flipkart, where he was VP Business Finance. And what we're given to understand now is that he's likely to go back to Flipkart, which, remember, is also headed towards an IPO. Now, both Blinkit and Eternal did not comment on this movement, but this is what sources are given to the sources are telling us. And remember, this comes at a time where the competition continues to heat up in the quick commerce space. We are seeing a lot of fund infusion also that has been happening. For instance, Eternal itself, right, it pumped in about 600 crores in Blinkit in November to grow Blinkit. Zepto has just filed confidentially for a 1.3 billion IPO. Swiggy also raised 10,000 crores via QIP, and that was mainly aimed at growing Instamart and keeping up with the quick commerce race as well. And earlier it used to be mainly a 3-player race, but today that's not the case. We have so many new players that are also aggressively growing in this space. For instance, JioMart has also been quietly quite aggressively growing. It is adding close to 0.4 million weekly active users. Amazon also has been really ramping up Amazon Now. It has a commitment of, adding 2 new dark stores every day. That's what the company has said. Flipkart is also rapidly scaling up its minutes offering. In fact, in 2025, it had about 53 million unique visitors that came to the website. And if you look at the weekly active users also, the competition is really heating up between Zepto, Blinkit, Instamart, Big Basket, JioMart. All of them are adding anywhere between 0.3 to about 1.2 million users. So at a time where competition is really heating up, the movement of the CFO from Blinkit to Flipkart, which is now going to come up with an IPO, will be an interesting move to watch. Back to you.
It will be, Shilpa. Thank you so much for bringing us all those interesting updates, what's happening at the leadership and the general trend that we are seeing in the quick commerce space as well. This is about Eternal. Now let's talk about all the other buzzing names that we have on our radar. Vivek is here with us on the big wall to talk about the stocks which are moving in trade. Vivek, what do you have for us?
Well, thank you so much for that. It's expiry session and it's volatile along expected lines, a very volatile trading session, flitting between green and red, even the benchmark indices. In terms of individual stocks, individual sectors, first have a look at the auto pack. Remember, December auto sales will come out on the 1st. And on the back of that, most of these names, after a brief spike today, have once again cooled off quite significantly. M&M, however, higher by almost 1.5%. Hindustan Copper, that particular name, the rally continues in that particular space. Yesterday, it did see significant cooling off, but today, on good volumes, higher by over 6%. Honasa or Mama, that particular name, promoter buying activity seen. On the back of that, on good volumes today, the stock is higher by 5.5%. The entire metal pack, once again, is seeing some amount of positive traction. Names like Nalco, NMDC, all of these names up anywhere between 1.5% to 3%. And JBM Auto, another name from the broad end of the markets, continues its up move for the second straight session. Some action on the JBM group side, but this particular name higher by over 4%. On the other hand, quite a few stocks seeing selling pressure as well. Yesterday, you did see railway stocks correct significantly. Today, it's the turn of defense stocks. These particular names are seeing quite a bit of profit booking emerge after the outcome of the DSE meet yesterday. Names like Bharat Dynamics, PL, all of them cooling off quite significantly from recent highs. Kaplan Point, on very high volumes, this particular stock has fallen quite significantly today, down almost 6%. Happiest Mind has once again hit a fresh 52-week low in today's trading session. And Angel One, this particular name, has been a significant underperformer, especially in the last 7 to 10 trading sessions. Today down by another 3%.
Okay, all right, Vivek. Thanks very much for that. Well, on that note, we'll take a short break, but we'll focus on PE and M&A deals in the healthcare sector on the other side. Stay tuned. Welcome back. Well, let's now focus on PE and M&A deals in the healthcare sector. And EY reports says the deal momentum has picked up this year. We have with us Kevan Movdawala, national healthcare leader, EY Parthenon, India, and B. Abhinay, who's the CEO at Kim's Hospital, to discuss this and more. Kevan, welcome to the studio. Thanks very much for joining in on what might be a very light week for you. And Abhinay, thank you very much for taking the time out as well. Well, you know, Kevan, I'm going to start the conversation with you because we've seen that deal momentum, in fact, continue in 2025, which really started post-COVID, where the deal momentum in, you know, especially the hospital space, not only diagnostics, but leading by hospitals has really been at the forefront. So just give us a sense in terms of what is actually driving this deal momentum.
I think in sync with today's buzz, I think the sector is a real dhurandhar. I think in the last year we've had 135 deals translating to almost 5.5 billion flows, sustaining the last 2 years' flow of 6 to 7 billion. 6% of today's the deal flows are now into healthcare versus 2% which was there a few years back. So clearly you're seeing this velocity, you know, 3.5 times more compared to pre-COVID. And Ekta, what's really driving this shift is this tectonic driver of organized healthcare being a preference of the consumer. So consumers want branded quality, you know, healthcare for their needs. We were just doing an analysis. You just look at the metros. The quality players used to have 30% market share a few years back. That's ramped up to above 50%. So almost galloping at twice the rate compared to the unorganized, largely driven by scale. You know, you're creating micro-catchment dominance, top of the patient funnel really flowing in, and clearly high acuity work getting channelized. Lastly, if I just look at it nationally, Ekta, the organized segment is 30% of the market. The listed players represent 17% of the market, which drives a market cap of roughly around $50 billion, right? That's a 1:1 ratio to the market size. If I just compare with pharma, it's a reference surrogate, has its own nuances. Pharma, the market is 85% organized, right? The market cap is 275 billion, which is a 5:1 ratio. So clearly, I think the prognosis, Ekta, is that a few years down the line, India healthcare market, clearly 45 to 50% will be organized. 30% of that, 35% will be the listed players. 2/3 being largely the existing incumbents or the existing listed players. And 1/3 being at least 8 or 10 more IPOs like Manipal, Yashoda, which are expected over the next few years. So clearly, I think this juggernaut is going to, you know, rapidly gallop. We are seeing a patient class which is really consuming high quality healthcare.
Okay. Abhinay, you know, I just want to get you into this as well because we've seen that M&A momentum continue. But companies such as yours, what kind of M&A are you looking at? Are you looking at, say, single specialty because that's where a lot of the interest and the money has come in? Or are you looking at multi-speciality where maybe the competition would be higher?
So, first of all, thank you for asking me. I think as a company, we're looking at only multi-speciality hospitals. We're not looking at single specialty hospitals at all. And if you look at the last 10 months or last 1 year, we have done 10 acquisitions. And all of them are multi-speciality hospitals, standalone hospitals. We usually prefer acquiring standalone hospitals where doctors have started together and then we partner with them and scale up the hospital. So for us, the size of the hospital, the scale of the hospital, how much we can scale it to eventually, all of those matter. Single specialty is something that we've stayed away for a long period of time because I think that's not where our expertise is and we want scale and, you know, to do more multi-specialty hospitals.
Okay. Kevan, let me come to you on this because you spoke about how much the listed players will be as a part of that organized market. You've seen a 3 times increase already in terms of the deal size that has come by and also the share coming in from organized players, basically. Which are some of the sub-sectors which are contributing to this growth? Yeah. Is there anything specifically which is working right now? And would that trend continue going forward?
Yeah, I think there are 5 or 6 investment themes. And this 50 billion market cap that I spoke about, I think with the organization happening at the pace that we are talking about, my sense is that it will be a $250 billion industry over the next 5 to 6 years, right? So that's a 5x growth. And I think 5 or 6 themes to your question. I think first is clearly mergers at scale. right? The Aster QCIL platform, where you've now emerged as one of the top 3 platforms in the country. You've got then specific healthcare platforms being created. The KKR-backed Baby Memorial Hospital, which started in Kerala, taken an acquisition in Tamil Nadu, doing something more. You've got regional chains getting lapped up by the national chains. The Sayadri one was a marquee exit for Ontario to Manipal. You've got the larger corporate chains doing bolt-on acquisitions. Max has done 3 or 4 in the last 2 years. Fortis has jumped onto the bandwagon. Single specialty, Ekta, you alluded to the fact that 10% of the PE flow used to be in single spec. Now it's close to 30%. So single specialty, eye care, IVF will play an important role. And gradually, I'm also seeing integrated platforms coming together, where you've got different single specialties, pharma, diagnostics, all coming together under one platform to create an integrated ecosystem, right? So I think all this is going to shape the consolidation. And interestingly, when you saw the statistics, the last 2 years is the first time where the M&A deals have outstripped PE. So of the 130, 140 deals, 85 were M&A, 55 were private equity, even in terms of value. So the PE-backed cycle has started, and M&A is clearly seen.
Is that because maybe there is some amount of drying up also in the...
True.
In terms of the assets.
The scaled assets are drying up, and which is why the platforms are becoming larger, and you want to pick up through a ripple strategy approach, smaller hospitals, and then create a platform around it.
But what about, you mentioned metro cities,
Yes.
tier 2, you were talking
Yes.
about that as well. So now, do we expect more such M&A deals or mergers coming in towards the tier 2 cities, tier 3 cities?
So excellent question. So we did an analysis of the top 25 cities, 7, 8 metros, 14, 15 tier 1, tier 2 cities. These 25 cities have 100,000 quality beds. Next 5 years, this is going to become 150,000. Right? So 50% capacity expansion happening across these cities, right? Also, what we are seeing is that in if I look at the expansion pipeline of the listed players, I think there's 20,000 beds under pipeline, 40,000 crore capex. 60% or 65% of that is going to be metro. But 35-40% is also going to be the tier 1 cities, the cities with 1 million, 2 million population, with large catchments, drain-in. Doctors want to go back to these smart cities. You get real estate at a frugal, level of cost. And the patients are also obviously seeking high quality healthcare in these tier 2 states. So I think it's a question is both.
Which are the companies which are leading to this capex? And talking about moving to tier 2, tier 3 cities, are there some other aspects that these companies should be, or the hospital companies should be aware of? How is it different from, say, metros? Is the expansion as easy, or is it more difficult? How does the regulation...
So the competition is obviously lesser. So if I look at the metros, most of the metros are seeing 5,000 to 8,000 beds being added over the next 4 years. The tier 1 cities are seeing 2,000 to 3,000 beds getting added over the next few years, right? So we're seeing all the players really focusing on tier 2 also as an important foray. Like I said, 30 to 40% of the expansion is planned in tier 1, tier 2. And one last interesting statistic is when you spoke about the top chains. I did an analysis of the top 13, 14 chains. The ones who've been inorganic focused have actually grown at twice the ones which have been non-inorganic focused. So they've grown at 27, 28%. Versus a typical chain growing at 13, 14%, who's not used inorganic as a lever. So M&A is going to become a crucial lever or a ramban for expansion and value creation in these markets.
I'm going to toss that over to Abhinay. Abhinay, you've been very active in terms of the M&A front, and you're saying that you're not looking at super speciality, you're looking at multi-speciality. So just give us a sense in terms of what the pipeline for M&A looks like, or the plan for KIMS when it comes to M&A in the super speciality segment looks like for you all in this coming year.
Unfortunately, it's slowly drying up like most of the discussion.
Yeah.
I think last year has been a lot of action. Last 2 years, a lot of private equity, multi-specialty hospitals looked at curating a lot of it. The following year, FY26, we have a lot of greenfield hospitals that are getting commissioned, 4 or 5 new greenfield hospitals that are getting commissioned. But we don't see any M&A opportunity at this point in time.
Okay, so you're holding back at this point. But, we've seen companies also go international now. For example, we saw Narayana make that deal in the UK. Is that something that maybe KIMS would think about?
No, we're currently very focused on building something in South and Maharashtra. I think a lot of our M&A that we're doing, greenfield that we're doing, are restricted to Maharashtra and south of India.
Okay. All right, Abhinav, as well as Kevan, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So it's interesting. The takeaway is that maybe the deal pipeline would possibly not look as robust simply because the assets seem to be drying up at this point in time. But nonetheless, let's see whether hospital companies look at shores beyond India to maybe increase their capacity. But we'll take a short break. But on that note, Sudeep Shah of SBI Securities will be joining in on the other side with some trading calls. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. As of now, Nifty at 25,890 levels. Day's lowest point is what the Nifty is trading at. On that note, let's bring on board now Sudeep Shah, Head of Technicals and Derivative Research, SBI Securities, to talk to us about the technical levels that we should be keeping an eye out on. Sudeep, good afternoon. Thank you so much for joining in. Obviously, today is expiry day, the last day in terms for December expiry as well. What are we keeping an eye out on in terms of levels? How important is it going to be to watch out for 26,000? And what are we watching out for in the Jan series now?
Yeah, good afternoon. Since morning, what we are seeing is there is a lot of sustained selling pressure at higher levels post that initial 30-minute rally, first hour rally. We've seen 25,950, 25,970, which is closer to the 50-day exponential moving average, act as a resistance. And we feel that that could be a resistance, not even 26,000, 25,950, 25,970 zone, which is closer to the day's high today, will act as a resistance. And till that is not crossed, support zones closer to 25,780, 25,800 could get retested. So that's what we feel, that it could be a range bound kind of expiry with some kind of a negative momentum attached with it. On the bank Nifty front, we feel 59,030, 59,100 zone. This 50-70 points range could act as a tighter resistance. So till 59,100 is not crossed, we feel 58,700, 58,730 for the day could get retested. And overall, 58,500 would act as an important support on the downside.
Okay, and what about individual names?
Individual names, one large cap stock and one mid cap stock that we like. Large cap is Larsen. What we've seen is that here from lower levels, from 50-day moving average, which is closer to 4,000 levels, there was a strong pullback since early morning, and that is an important support zone. Also, the last couple of weeks, also that zone has acted as a strong support. So we feel that in the current scenario where there is some kind of pressure on the mid caps, select large caps would hold place, and we feel here Larsen can move to 4150, 4180 on the upside, and on the downside the stop loss could be 3980.
Okay, all right, we're going to let you go. Okay, maybe we could just ask you about a couple of other key stocks that you're looking at. Just wanted to understand whether you have a view on a couple of these stocks such as Hindustan Copper, which has seen multiple sessions of an up move, and how you would approach it.
See, Hindustan Copper, if you see, yesterday there was a big sell-off from the higher levels, but today the same closing level closer to 480, 490 acted as a strong support. And now from a fresh entry perspective, I feel the risk reward is not too good. So those are holding. I would recommend them to hold with a trailing stop loss at 490 for a continuation of the upside closer to 550, 570 levels. But fresh entries at this level in this stock, I don't feel the risk reward is quite good.
So, one-way rally, Hindustan Copper, we see newer highs every day. So that stock continues to be on our radar. Thank you so much for joining us today with your F&O trades and picks for the day. That's all about what the charts are suggesting. But let's go across to Mangalam. He's joining us with what the F&O setup is looking like. Are the bulls and bears on holiday already, Mangalam?
Well, the market's at the low point of trade right now, which is not saying much because at the high point they weren't much higher as well. So give or take everything, today's range on the Nifty has been sub 100 points, 96, 97 points, so to say. The Nifty bank is down by 27 points, and we have the mid-cap index, which is down by about 0.5%. And that's where a bit of a pain is. The only difference is that, as the market's at the low point of trade, it's also gone below the 50-day moving average. So that is an important technical level that we have to monitor, reclaim perhaps for bulls to have a little more hope from tomorrow's session, which is the last trading session of 2025, but also the first trading session of the January series. Importantly, the market breadth as well over the last 4 or 5 trading sessions has been firmly in favor of declines, and today the lines did appear to come closer at one point in time, but thereafter they widened once again, with the red one being a fair distance away from the green one. The top losers in the broader markets, we have names like Solar Industries, Mazagon Dock, a couple of these defense names which are coming in for some selling. Cement names like JK Cement and Berger Paints also has seen some selling, down about 3 to 4%. But on the way up, the metal names continue their rally irrespective of the decline that we've seen in commodity prices overnight. So we have Hind Copper over 60% gain this month so far, a 7% gain today. We have Jindal Stainless, which is up 2.5%, SAIL as well, up almost 3%. What is it that the street is betting for in terms of expiry range for December series, which takes place today? The December series so far, the Nifty has virtually not moved more than 20-30 points. And right now, the street does not believe that it will move beyond that as well. The 25,900 put has a premium of 30 rupees. So telling you where the Nifty is right now, 25,870 thereabouts, is an important support zone. There are about 3.2 crore shares outstanding. If the market falls further, then these put writers will have to unwind their positions and there could be a further decline. However, on the way up, call writers are equally active at 25,950 call and now increasingly 25,900 call as well. So the market does stay above that 25,920, 25,930 mark. We may see an up move from a short covering standpoint, from a call writer's perspective. But both these option writers aren't expecting the market to move much beyond this 25,900 fulcrum where the Nifty has been trading all through today's session, despite being at the low point of trade right now.
Okay. All right, Mangalam, thanks very much for bringing us all of those updates on the F&O space. We'll take a short break, but on the other side, Manisha Gupta will join in. She has with her the energy expert Narendra Taneja joining in. Stay tuned.
Welcome back, and joining us now is energy expert Narendra Taneja. Mr. Taneja, hi, thank you so much for joining in. And while most of the commodities really seem to be making all-time highs and record highs, what hasn't done in sense of a segment has been energy. And we're looking at surplus one, and second, the demand concerns as well. How would you look back and look at 2025? And would you say that much of what we are looking at in sense of fundamentals is what we will carry into 2026?
Well, looks like if you look at the last couple of months and the way, for instance, crude oil has trended globally, it appears that, at least in the first quarter of 2026, we are going to be witnessing more or less the same kind of landscape and scenario. Unless, of course, there is some major geopolitical trigger, let's say, in Venezuela or over Venezuela, whereas, the U.S. is very active and Venezuela, when it comes to oil, is a superpower. They have the largest, oil reserves in the world, but there are some political reasons. So unless there is a kind of geopolitical trigger, I really don't see. When you look at the demand is mainly led by India and a couple of other countries and regions, including the Middle East. But that's not enough really to drive the prices up. As you know, that President Trump is very keen to keep the prices low as possible, but not below 60, because 60 they need in order to keep the shale industry in good shape, because less than 60, then the shale can get into trouble that he doesn't want. But $60, the U.S. seems to be very comfortable, and that's what they want. India is extremely comfortable. Russia is reasonably okay. And most other countries are not complaining, except maybe Abu Dhabi and Iraq and a few others. But overall landscape looks like the first 3 months are going to be what we have witnessed the last couple of months, provided, of course, there is no geopolitical earthquake.
Mr. Saneja, there are various reports also suggesting that there is a possibility that we could be looking at crude oil prices slipping below 60. In an event like that, do you see OPEC Plus doing a turnaround, and what is a threshold or what is a level that you would see OPEC Plus in that sense defending?
Well, good question. I mean, my sense is that, if you really go by demand and supply fundamentals and keep the geopolitics out and, and take out the geopolitical premium, oil today should not be more than $58 per barrel. If you go strictly by demand fundamentals and the fact the market is very well supplied and there is plenty of oil on the horizon, I mean, the new discoveries and new production fields. So given that kind of situation, but at the same time, OPEC at this stage doesn't really have much to do. OPEC without Russian support cannot really go too far. And at the same time, there is huge pressure on Saudi Arabia to keep prices low in the region of $60 per barrel. And OPEC is essentially Saudi Arabia. So unless Saudi Arabia and Russia, they come together, they come on the same page. And it appears that, right now they want geopolitical stability. Even Russia seems to be keen for some kind of solution over Ukraine. And if that happens, then I think we are going to see oil maybe about $55 to $58 per barrel if there is some kind of breakthrough over Ukraine, which does look like unlikely to.
$58 to $58 a barrel, only if there is a peace conversation that we see happen between Russia and Ukraine. Now, Mr. Zaneja, the other thing really is about natural gas. And when you look at that chart on most of those commodities in 2025, natural gas is the only positive. We are looking at seasonal inventories below 5-year average and the expectation that the demand is going to be much better going forward. We'll try and get Mr. Saneja back. But when you look at the overall chart, while we have seen the crude varieties, all of that on a declining side, it also is about heating oil, gasoline, coal prices, TTF gas prices. All of that has been on a decline. But Mr. Taneja, natural gas is the only one that seems to be trading in the positive. Would you see positive cues continuing?
As far as the natural gas is concerned, I think the demand is going to see only one direction, that's up. Okay. Two reasons for that. Number one is demand for gas is growing because majority of countries are following this mantra of green energy, and as you know, natural gas is considered green energy. Strictly speaking, it's not, but that's a different debate. But it's considered a green energy. Second reason is that unlike oil, which is a kind of global market, natural gas is a fragmented market in the sense Europe has its own universe. Asia has its own universe, America has its own universe, but at the same time, thanks to LNG, where you can ship gas from one part of the world to another, you see, it has also now partially become a kind of global commodity. So that is the main reason. And there are countries like India, Korea, Japan, China, and they are actually, showing more appetite for natural gas. So which is a good sign, and therefore you find that Arctic route is opening up, and there are many other countries which are, trying to export gas to the energy deficit countries, gas deficit countries like India. So, and I think in a couple of years you're going to see gas acquiring a completely different status, and there is going to be more in demand. As far as the prices are concerned, since there is plenty of gas available, the prices are going to see up and down just like we see in oil, but. But gas is kind of more long-term agreements driven, especially when it comes to pipeline, like between Russia and China, certain countries between, in the Middle East to Europe and so on and so forth. It's a completely different universe when it comes to gas. So we cannot compare it with oil. But gas, we are going to see kind of, more demand. We are also going to see gas emerging kind of quite sovereign in terms of his own way of looking at the world, and also in terms of his regulation, prices, geopolitics, and so on.
Okay, Mr. Taneja, thank you so much for joining us this afternoon. And Manisha, thank you so much for joining in and taking us through that conversation. Will be important to see in terms of the changes that come in from the side of gas as well, and how it moves going forward in terms of prices. But thanks so much for that conversation. On that note, we're going to slip into a very short break. Up next, Sudarshan will focus on the key trends in the two-wheeler EV space in 2025. Stay tuned in.
Welcome back. Well, 2025 turned out to be a year of shifting gears for electric two-wheelers, where bold promises met hard execution and legacy OEMs steadily took the lead from startups. Sudarshan is here with a complete picture of this. Sudarshan.
The year 2025 began under the shadow of bold declarations from industry leaders, setting the tone for what promised to be a transformative year. Bhavish Agarwal, founder of Ola Electric, had stated in August 2024, and I quote, "Tesla is for the West and Ola for the rest." He added, Ola Electric is the first listed EV company in India and ground zero of India's EV revolution. By revenue, we are the fourth largest EV company in the world, I unquote. These statements reflected the ambition and optimism surrounding India's EV two-wheeler sector. Meanwhile, legacy players were ready to remind the market that execution mattered. Rajiv Bajaj of Bajaj Auto quipped in December of 2024, Ola to Ola hai, lekin Chetak Shola hai, signaling that traditional OEMs were prepared to challenge the early mover advantage of startups like Ola with proven reliability and strong dealer networks. At the start of 2025, Ola Electric continued to be among the market leaders with market share in the mid to high 20% range in the first couple of months. But as the year progressed, that dominance steadily weakened. Ola's market share fell into the high teens by mid-2025 and in several months slipped below 20% as rivals ramped up production and retail execution. In contrast, TVS Motor and Bajaj Auto consistently gained share, frequently topping monthly sales charts. Ather Energy also strengthened its position, narrowing the gap with Ola. While Hero MotoCorp's Vida grew rapidly from a smaller base, by the second half of 2025, the electric two-wheeler market had clearly transformed from a startup-led phase to one dominated by legacy OEMs. So what went wrong for Ola Electric? Operationally, the company faced execution hurdles with production volatility and delivery inconsistencies leading to uneven month-on-month registrations. Ola's dealerless, direct-to-consumer model, which had earlier helped it scale rapidly, began to show strains as competition intensified at the retail level and rivals strengthened on-ground presence. After-sales and customer experience issues further weighed on sentiment. Complaints related to service quality, software glitches, and longer repair turnaround times dented brand perception. Importantly, Ola was not the alone. The entire electric two-wheeler industry faced meaningful headwinds in 2025. One of the key challenges was subsidy normalization. With government incentives lower than in earlier years, the effective acquisition cost for consumers increased, tempering demand, particularly in price-sensitive segments. Another issue faced by the industry was disruptions and tightness in the supply of rare earth magnets, a critical component for electric motors, which created uncertainty for EV manufacturers. This led to intermittent production constraints, delayed deliveries, and in some months added to the sharp month-to-month volatility in EV sales. Even as the long-term growth trajectory for electric two-wheelers remained intact, rising competition further altered the industry landscape. Nearly every major two-wheeler OEM now has a presence in electric mobility, significantly expanding customer choice. As a result, market share became increasingly fragmented, intensifying the battle for volumes and brand loyalty. Adding to these pressures were profitability challenges, elevated battery costs, aggressive discounting to sustain volumes, and high marketing spends meant that achieving consistent profitability remained elusive for many players across the industry. But despite these challenges, the electric two-wheeler story in India remains structurally intact. Total industry volumes continue to register year-on-year growth, underscoring steady underlying demand. Importantly, EV adoption expanded beyond metro markets, with penetration improving in Tier 2 and Tier 3 cities, supported by better charging access and rising consumer awareness. At the same time, product quality saw meaningful improvement. Newer models offered longer range, better reliability, and more stable charging performance, addressing some of the early adoption concerns and strengthening the long-term case for electric mobility in two-wheelers. So, 2025 will be remembered as a year of transition for electric two-wheelers, where leadership shifted, competition intensified, and execution became more important than disruption alone. For Ola Electric, the year exposed the challenges of scaling sustainably, and for the industry, it marked the beginning of a more mature, more competitive EV phase one, where consistency, trust, and service will define the winners.
It will. Thank you so much, Sudarshan, for bringing us those interesting insights in the EV two-wheeler industry. It's been a very interesting year. We'll see what lies ahead in 2026. With that, we'll do one thing. We'll slip into a break. When we come back, we'll get you more on the markets and talk about some stock-specific action. Stay tuned for that. Welcome back. We continue to be at the 25,900 mark, very range bound for the markets. The Bank Nifty briefly slipped into the green or came back to the green levels at that 58,900 mark. Metals continue to do well. That's the top gainer in terms of sectoral movers, followed by Nifty PSU Bank, which is lending some support to Nifty Bank as we speak. Autos and media index, that is also doing well in trade today. Realty continues to sulk. That has been a big underperformer this week and this month as well. From the broader markets, we have Timex, which continues its up move after the block deal or the stake sale that we saw yesterday. So that stock is up 5.5%. We do have JBM Auto. We were talking about E2-wheelers. That's a company in electric vehicle generally. So that stock is up around 3.5%. Nalco, Sale, all these metal names or the from the industry, these stocks are doing really well. So watch out for the metals index because that continues to be a top mover. Mid-cap index continues to be lower with the advance decline ratio in the favor of declines. We'll do one thing. We'll take your leave on this edition of Halftime Report. Business Lunch will take all the action ahead.